Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything mutual fund related, whether it comes to selecting the mutual funds that go into your portfolio or broader strategy. And in fact, the latter is what we're going to be talking about on today's program. It's been a bit of a theme this week. My colleague Neeraj has been speaking to chief executive officers of mutual funds and asking them how the construction of a portfolio should change, how strategy should change, given everything that's happening on the global side, as well as what is happening domestically as well. Of course, some aspects of that include the imminent start of a Trump presidency and how that will affect global trade and indeed India. Joining me in studio today is Ashish Somaiya, who is the Chief Executive Officer of White Oak Capital AMC. Ashish, thanks as always for taking the time, and thanks so much for coming to the studio.
Thank you. Thanks for having me.
So, you know, that saying, we live in interesting times, I don't think that has changed over the last several years, and that continues to be the case. But as we head into the next year, what are the key factors that you're paying attention to?
So, I always tell clients and advisors that, the risk is in your portfolio, the risk is not in the markets, right? It's very natural and very normal for everybody to look for risk in the markets. So, everybody, like you rightly said, that, something will change when the presidency in the US changes, correct? But unfortunately, it's very difficult to forecast, right? Like, I'll give you an example. Somebody was telling me, and a lot of people say this, that when Mr. Trump becomes the president, then how will it be for China? How will it be for geopolitics? So I asked the guy, are you the same person you were 4 years back?
That's a good question. And that certainly the answer is no.
Yeah. So our views change. And we are ordinary people. I mean, you're talking about the American president, right? So his views change, his team changes, correct? And it's known that he's somebody who believes more in bilateralism and in deal making rather than multilateralism and, the world order and those kinds of things. So yeah, some things will change, but the reality is that we don't know what goes on in his mind and what goes on in Mr. Musk's mind, and it's not possible to forecast, correct? So that's why I tell people that everybody looks for risks in the markets and everybody looks for risks in a Trump presidency, whereas the risks are pretty much in your own portfolio. Right? So getting to the point, like, why did I say this, is because if you see, forget all of this and look at client portfolios. I'll give you just a simple example. If you take the market cap, the equity market cap, you'll realize that in the last 15 years, on an average, large cap has been 70% of total market cap, right? Right now, large cap is 61 or 62%.
Yes.
And somewhere in 2013, large cap was 77 or 78% of total market cap. So now, Alex, if somebody says that, I'm a neutral investor, I'm not aggressive, I'm not conservative. So my large cap allocation should reflect market weights. If I'm a very aggressive guy, I'll have more money in small and mid cap. If I'm a very conservative guy, I have only large cap. But somewhere for a moderate guy, your portfolio allocation should reflect the broad market. And then you may be, some plus minus. But in the last 12 months, till 31st October, in 12 months, mutual fund investors put 3.5 lakh crores into pure equity funds.
Yes.
Take a wild guess how much of that was large cap.
I know that most of it was sectoral and thematic funds.
It's only 4% large cap. So if you add 50% of large and mid cap funds and 60% of flexi cap funds and 30% of multi cap funds, and you do all of that, you'll realize that less than 20% went into large cap funds. Like you rightly said, 40% or 50% went into thematic funds, and then a whole bunch into small cap, mid cap and stuff, right? So long story short is that, look, you and me can keep debating about Trump presidency, but if people are going to put all their money into micro cap, small cap and few themes like defense, PSU, energy and utility, then you know where the risk is. It's not in the presidency of US. The risk is already in your portfolios, right?
So then let me ask you this, Ashish Somaiya, you as an investor, of course, you have your own risk profile and your own requirements for why you invest. But as you get into 2025, are you tweaking your portfolio in any way? Are you anticipating that certain things will change?
Yeah.
Or have you already done that, expecting that things will change?
So, if you ask me, say, what I have been telling people and what I would do for my own portfolio also, is that, get the portfolio into the center of the market, right? The market is very much 60-70% banking, financials, IT, consumer, healthcare, and all these kinds of things. Like I already said, the market is pretty much 60-70% large cap, right? But what is happening is that people's portfolios have been getting allocated more and more into some corner, crack, or crevice of the market where they think that they're going to get outsized return, right? And in the last 3 years, rightly or wrongly, in the last 3 years, that's worked for them. But like we spoke earlier, you have to shoot where the rabbit will be, right? Not, where it was. So I would tell people that bring the portfolio back into the center, meaning that, get a bit more neutral weight when it comes to the market. You're definitely underweight large cap. So rebalance in favor of large cap. You're definitely in all the hot sectors of the last 3 years, which were the high beta, cyclical, commodity, the conglomerates, and the PSUs and stuff, right? In the last 5 years, the banking and IT index, and say maybe consumer, they've underperformed Nifty. This defense, PSU, etc. has given 3 to 4x of Nifty. But if you see the last 3 to 6 months, the market has already reversed this. The darlings of the last 3 years are 20-25% down from the 52-week high.
Right.
And the non-consensus laggards or dogs, they are 20-25% up from their bottom. So it's not so much a market correction. The headline Nifty may be 7-8% down. But there is a violent rotation and there is a correction which is already played out. Look, the Nifty may not correct, but if your favorite sector is 20% down and the sector you're not even looking at is up 20%, it's a correction.
And for you, it's definitely your portfolio is going through something.
So I'm just saying that, for next year, before next year, I would just tell people to revisit their asset allocation in all forms and formats, whether it is large cap, mid cap, small cap, whether it is a sectoral balance, whether it is overexposure to equity. I think we've had a dream run. I'm not pessimistic about the upcoming year or so, but I just feel that, you can't keep playing a soccer game in the penalty area. I mean, for 70% of the time, you're passing the ball and it's in the middle of the field. I mean, people have been in the penalty area for far too long.
That's a fair point. Speaking of rebalancing, this is actually a question that I'm asking more representatives of mutual funds, either from the actual management side, or of course you will also have a perspective on how the fund manages the money right now, what the strategy is right now. What is the BAF strategy right now? In that, is this tending more towards underweight on equity, more on fixed income? And the reason I'm asking, the context of course, is that today we had a brokerage saying we could see a cut in interest rates when the RBI Monetary Policy Committee's outcome of the meeting comes out tomorrow. Of course, that's way too near term. But directionally, we are heading into 2025 with the expectation that interest rates are going to come off. That's good for bond yields.
So, I think this is all a bit counterintuitive. Like, see, till now what is happening is we actually got less than anticipated earnings data. We actually got, unexpected GDP numbers. Right? And the market is stoic or, Teflon coated. Correct? And people are expecting that maybe some liquidity adjustment, but they don't expect RBI to cut rates. Now, how the market works is that if RBI cuts rates, people will think, oh, gosh, what do they know which we don't know? So let's not jump to conclusions about any of this, right? I mean, if there is an equal chance, smart guys will say, oh, maybe it's worse than we thought. How come these guys have become dovish, right? So all these macros are really tricky, tricky. It can cut both ways. Correct? You see, we spoke Trump presidency. In 2016, market was nervous Mr. Trump might win. In 2020, market was nervous Mr. Trump might lose. And now market is excited that he has won. So I don't give much credence to...
it's like reading tea leaves, is it?
Yeah, I mean, it's just market has moods, correct? So I would put it this way, that, even the monetary policy, I mean, it'll be good if they act on it. It's good if there is a change of stance, but I don't think that the market is running away in a hurry. Market has been on a tear for quite some time. You asked about balance advantage. So some parts of the market has been on a tear, but look, funnily, if I look at Nifty, 5-year CAGR of Nifty is 15%, and 5-year EPS growth of Nifty is 16-17%. So why I said come back to large cap? Nifty on its own is not looking like it's crazy, because there are some components of Nifty which have given 2-3x return, and some parts of Nifty which are underperforming. So when I say rebalancing, it's just that get to the cheaper parts of the market, get to relative value, and our balanced advantage fund is indicating 53-54% equity, which is not aggressive, but definitely we are not running away.
Understood.
So all of this is just about reducing risk in the portfolio, not entirely leaving the market. That's the point.
Because the Nifty 50 ultimately is less than the 5-year average at this juncture.
Yeah, exactly.
Interestingly, another aspect is the steadiness and continuity of investments. And I'm speaking to you about this because it was indeed White Oak Capital's study on SIPs and continuity of SIPs. Ultimately, that strategy has stood the test of time. You want to go through that?
Yeah, see, if you really see the whole learning, if you take the whole history, it's, let's say in March 2023, when we had that Silicon Valley Bank, Signature Bank, etc. Now today, if you see, people are consistently investing 26,000 crores per month, right? We'll get November numbers, we'll see. But I can remind you that as recently as March 2023, if you go back and see the discussions, there were some signs of people stopping SIPs and people thinking, look, I'm contributing for 12 to 15 months or 2 years, and now, after 2 years, the value is negative. So every once in a while, these kind of things will come up. But ultimately, why do we do SIP? We do SIP because there will be a point in time when market will do something unpredictable and we need to invest at every level, correct? So, I think right now people have been very, very consistent. You are seeing consistently rising SIPs. You are not seeing failure rates or stoppages. So this is great. But I think people need to keep that in mind if there are any eventualities which we don't know about. That's the key.
Okay. Last point, and I've spoken to your team about your multi-asset fund as well. And it's an interesting take on the multi-asset fund. It's not conforming to what a lot of people are doing in the sense that it is diversified and truly diversified in that sense.
It's a genuine,
Yeah, so what are the strategies that are being employed there that you can probably take through to the rest of an individual's portfolio if required?
See, I think one of the biggest mistakes which people make with multi-asset funds, everybody, advisors, AMCs, investors, generally, that's just my perspective, that a lot of people make this error, which is that they have some presuppositions of how an asset class will do.
Should do, yeah.
Correct?
Right.
That's not the point. I always compare asset allocation to chemistry, right? If you mix 2 or 3 different substances, it produces a 4th substance.
Yes.
The 4th substance doesn't look like any of the 3 which you put in as ingredients. It may derive some properties from each, but when it combines all of those, it has a different life of its own. It looks very different.
Yes.
Correct? So that's how asset allocation is supposed to behave. So what happens is today, if, like say in our asset allocation fund, we didn't start with any presupposition that gold will do well or that we should have equity 65% because equity taxation.
Yes.
We didn't do any of that.
That wasn't the objective.
That was not the objective. We just started building it ground up, saying that, okay, if we want low volatility and we want something which will be an option for people who otherwise find it a struggle to put money in fixed income. See, there was a point in time people used to put 3-year money into corporate bond funds and gilt funds and so many of those things.
They don't do that anymore.
Right? Now they don't do it because it is fully taxed. So you have to artificially construct an asset allocation such that it will give you the low volatility experience if you hold it for a couple of years and it can give you acceptable rate of return. So then the allocation comes very different. It comes like, more like 10 to 40% gold, 15 to 45% equity. So just take an example. Last 3 months, a lot of multi-asset funds have given negative return. We didn't give negative return.
Right.
In the month of October, BSE 500 was down 6.5%. Our return was positive. In the month of November, gold was down 3.5 to 4%, but our return was positive. So I'm not saying that you should assume it will give positive return every month, but I'm just saying that asset allocation should be viewed like chemistry. Right?
And it's downside protection.
Absolutely.
The last point that I want to raise with you is because you have the pulse again, and we are on the 5th of the month, we will soon have the numbers, but there were murmurs that said that, of course, October nothing happened, the numbers were spectacular. November, perhaps there was a little bit of selling. What was visible in the kind of trends that you saw?
So see, when you see the numbers, I would imagine, I won't be surprised if there is a reduced gross inflow number, but that should also be kept in mind. I actually counted there were only 18 working days in November.
Interesting.
Right? There was Diwali and the month started with weekend and then there were 2-3 more holidays and it ended with a weekend and those kinds of things. So only 18 working days in November. Second thing, I don't see any sign of redemption. There was no such exaggerated, nothing unusual I observed. But yes, I did observe that the gross equity inflow might be
A little lower.
a little lower. Yeah.
Interesting. But I think I'm curious because I also heard that the net number is not going to suffer too much.
Yeah, I mean, and I always insist that we should see gross number, redemption, and net separately. So that
because
we know the actual, because each of those is a variable. Net is just, net, it doesn't say anything.
Ashish, thanks so much for joining me in studio. Pleasure speaking with you as always. Insightful conversation.
Thank you.
All right, let's move this conversation forward. In fact, Ruchi Sankhe, investment advisor at Infinity Advisors, joining me right now. Ruchi, thanks so much for taking the time. And I hope that you caught some part of the last conversation that we were having in the studio with Ashish. What kind of advice are you giving to your clients, to people that come to you for advice heading into the new year?
I guess, in terms of portfolio construction today, as we've seen, the mid cap and small cap segments have not really corrected much. Really, the large caps are the ones who have taken some correction. So we are currently really not, basically underweight on the mid caps and the small caps and overweight on large caps. So the construction of the portfolios is happening accordingly. We're also, not wary with the kind of volatility that we've seen in the past. And so we are also trying to stagger in the flow of investments for our clients on the equity side. And as you know, as rightly Ashish was saying, there are many other funds that you can incorporate in the portfolio, which will give a little bit, in terms of riskiness, reduce the riskiness of the portfolio. So the alternative hybrid funds and multi-asset allocation funds have also come into play, and those are also being incorporated in portfolios as we stand today. So that's how we are looking at portfolio construction as we go in the new year. A little, safe and perhaps staggered over a longer period of time now.
Yeah, particularly because of what we saw post-August, right, Ruchi? Because I think a lot of portfolios that might have been aggressive at the start of the year have actually fared not too well. Have people come to you complaining, saying that, we've seen significant drawdowns?
Yeah, so there are significant drawdowns, but many of the equity investors understand that these volatilities can be short-lived, and the way to evaluate this portfolio is really over a longer period of time. So it was not something that equity investors, when they get in, don't expect to see. Yes, there have been significant drawdowns, and that has concerned investors, but they are also here to stay. So they realize that this may not be a long-lasting kind of an impact on the portfolios. So staying invested is really important, and not taking any decisions at this point of time to withdraw is really important. That's how we work with our investors to ensure that, they kind of stay patient and invested in the markets.
Ruchi, just zooming out a little bit and looking at everything that's happening across the globe, of course, you have a scenario in Europe which is not particularly great. You have political drama in parts of Asia. You have a Trump presidency that is in the offing. But at the same time, you have the data that is indicating that the US economy is performing better than some had anticipated at the start of the year. When you give your clients advice on how they should treat the international aspect of their portfolio, first of all, what percentage would you say is appropriate to have in a portfolio? And give me examples as to how you would have that inclusion. Would it be through passives?
So yes, a mix of both, Neeraj. We are doing some passives as well as some actives. Just to come back to your first question, the kind of proportion, it's usually between 5 to 10% on the international side. That's what we advocate. And, we've got the NASDAQ, Motilal Oswal NASDAQ ETF that we've used for investing in the international markets. Even the Franklin India Feeder Fund in the US markets, as well as some funds like the Parag Parikh Flexi Cap, which also have certain part of their portfolio invested in the international markets, is also a good way of accessing it. Of course, again, it goes without saying, given that these funds are treated as debt funds, it makes sense to hold these for a longer period of time. So we have been taking exposure more in the US and the international fund route through, let's say a Parik Flexi and the feeder funds. Those are the typical ways, but not more than 5-10% is what we've done. We have used the LRS funds as well for investing in the international markets, and that's a more efficient way to do so. So whatever additional that's required over and above the LRS that's been sent, these are the routes that are being used.
Yeah, interesting. I guess that's a topic for a conversation for another day. That LRS route is quite an interesting way to play global markets.
Oh, I'm sorry.
Yeah, no, certainly no. I'm saying that it's a conversation that we can have at length. May not be able to do it justice right now, but I'm saying from the perspective of the fixed income side of your portfolio, a lot of people have transitioned to using hybrid schemes to have that allocation because of the tax nature of it. But ultimately, we're talking at a time, Ruchi, when you could see an interest rate shift. You could see interest rates move down as early as this week, some might say. If not right now, then you're talking about early next year, where you're seeing interest rates going down. And so from that perspective, playing duration might actually be beneficial at this point. We've been saying this all of this year, but this is coming to a head finally. How are you advising your clients to play the fixed income side?
Firstly, apologies, I called you Neeraj instead of Alex. I'm sorry about that. But more than that, yes, you're right. We are creating. See, the issue that has happened is because the tax advantage has completely gone away. And there is a big now difference when you invest in a debt fund, you're actually paying taxes at marginal rates. Whereas when you do a hybrid fund, you end up paying similar to equity taxation, which is 12.5% at the end of 1 year. It eats away a lot of returns if you do it directly in the debt funds. Having said that, you're absolutely right. We are expecting interest rates to come off, and a certain part of exposure in the debt category can be taken through the gilt funds and the long tenor debt funds. And we are evaluating those as well, depending upon the client portfolios that are have debt exposure. A lot of investors are actually moving into hybrids and taking debt exposure through the hybrid category. But wherever we have debt exposure, corporates and long-term corporates and gilt funds are definitely being incorporated in the portfolios on the debt side.
Okay, let's jump to some of the questions, Ruchi, that we've got. The first one's from Vimal, and he is 50 years old. He's looking to invest in mutual funds for the purposes of his son's wedding. And he's asking for a suggestion on some funds. His period is, his investment horizon is 5 years. His target amount is about 25 to 30 lakhs. What would your suggestions be?
I think as we've been speaking in the show all along, at this point of time, if he's starting to create a portfolio, some of the segments have really run up on the equity side. Obviously, I'd like to create a portfolio which is more, growth oriented, so that he can get returns in this portfolio. The investment horizon also 5 years is reasonably, decent in terms of investment. So you would have more equity. So I would create at least a 60 to 70% equity portfolio, and perhaps the balance 30 to 40% could be through a hybrid route of investing, where there may be debt exposure, so that there's a little bit stability to that portfolio, and he doesn't get caught up if there is extreme volatility in terms of withdrawals. But I would create more in the large cap segment, or even a flexi cap fund, where the fund manager is taking the decision as to how much to invest in large and mid cap segments rather than us doing so. So I would say it should be more large cap oriented, around 60 to 70% equity, and incorporated with some multi-asset, equity savings schemes and flexi cap funds. So that's how I would create it at this juncture. I would stay away from small cap and mid cap at this juncture, and really do it only through the flexi cap route.
Okay, Ruchi, you've named this categories. I'm not asking you to give recommendations, but the schemes that you like in these categories?
So in the flexi cap, obviously my all-time favorite has been Parik flexi cap, but the HDFC flexi cap has also been doing very well. So those two funds I like in the flexi cap. And HDFC flexi cap, of course, today would have only about a 46 to 47% exposure in large cap. So it is still more mid cap and small cap oriented. But that's a good way to take exposure in those segments rather than taking it directly. In the large cap side, actually, I like a Mirai asset large cap. It has a quality bias, and it's growth at a reasonable price. I would consider a fund like that. I would also incorporate some index funds. So there are lower cost funds in terms of expense structure, which will give you Nifty linked returns. So those would be more on the equity side. And on the equity saving side, I would incorporate something like an ICICI Pru savings fund, because that actually has a net long exposure of only between 15 to 20% in equity versus a 33%, which most equity savings funds have. So I would look at something like that to get more safety and more tax efficiency in the portfolio on the debt side.
Got it. All right, Ruchi, thanks so much for joining in. Pleasure having you on the program. And in fact, that brings us to the end of this edition of the Mutual Fund Show. Thanks so much for watching. Do stay tuned. This is NDTV Profit.